Hi, everybody. Imagine being in a room, and over on one side, there is an elephant. It's still, it's quiet, no big commotion. I was wondering about that. Would you smell anything? Would you hear anything? Maybe hear it breathing? I think you might you might hear the floor creaking. But imagine that, and imagine other people in there with you, and nobody's really talking about it except for one or two people. I think that's the kind of situation that we have right now with the national debt. So there are a few people talking about it, right? Ray Dalio is one of those people. He wrote about it in his latest book, How Countries Go Broke. And there's also another group called the Committee for a Responsible Federal Budget that publishes a lot of stuff. But this last month, they published a document on how the fiscal crisis might look should we have one. It's interesting. Dalio provides a lot of background research over hundreds of years in dozens of countries. And the CRFB doesn't go into a whole lot of research detail, but they're much richer on describing how the crisis might take form. And in doing so, they've come up with 6 different scenarios. So they look like this. I'm not going to go through each one of these. I'd actually encourage everybody to go to that website and download the report and read it. It's 10 pages. It's fairly interesting. And it goes into a little bit of detail on each one of these. I try to think in terms of how I can help subscribers and YouTube viewers. And this is trying to figure out what is going to happen here, and is a little bit on the complex side, but I think it's actually simpler than what you might see here on this list of crisis scenarios. If you think about it, there's probably one of two things that's going to happen. Either prices are going to go up and we experience deflation, or prices are going to go down and there's going to be some kind of deflation. Now, you can think about the money supply, but just keep it much simpler. When prices go up, that means inflation. When prices go down, that means deflation. So if gas is more expensive than it was last year, okay, gas is having some inflation. If your real estate prices are lower in your area than they were a year ago, well, then they're getting some deflation. In reality, there's always inflationary and deflationary forces at work in the economy at the same time. So there's always this tension. Question is, which one predominates and how serious is it? Is it a little bit of inflation, a little bit of deflation, prices are pretty stable? Or is there a lot of inflation and all kinds of prices are going up? Or is there a lot of deflation and prices are coming down everywhere? Well, that's one way to think about one of these crises coming. The other one is speed. Does something happen in a day or in a week or in a few months? Something like the fall of 2008, right? The stock market fell. Or is it going to take a lot of time? Think about the inflation in the late 1960s all the way through the 70s up until about 1980 or 81. That was a gradual crisis going on. You think about Japan for the last 25 years, right? That's a very long-term gradual crisis. So if we combine these two, we come up with something that offers us some quadrants, right? And the quadrants look like this: acute inflation or gradual inflation. Does it happen suddenly or does it take a long time? Acute deflation, do prices drop suddenly, like in a stock market crash? Or is there this gradual decline over time? So as we think about this, this is where the quadrants give us a little bit of detail for imagining how the crisis might take shape. So if there's a currency break where the dollar just loses a lot of value relatively quickly, if the Fed comes out and says we're going to buy a whole lot of bonds, do something like quantitative easing, or if there's this inflationary shock, that's quick. Those are quick, and that's inflationary. Now, on the other side, down on the deflationary side, if it's quick and deflationary, that might look like a financial crisis, right? One of a couple of banks close or the stock market declines a lot, credit freezes up, and there might be a default shock, right? Now, it's unlikely that the U.S. government's going to come out and say we're not going to pay interest on the treasuries. But what might happen, see if you can imagine this, the Congress and the Senate get into a game of chicken. And on one of these government closings, they neither one refuses to negotiate, and the U.S. government winds up missing an interest payment or a series of interest payments over a short period of time. Well, that's not long-term default, but that's a short-term default, and that will shock the system. If we go over to the gradual deflationary side, we're looking at a Japan-style outcome. They've had little to no growth over the last 20-some years, and they're still working through or still having to deal with a lot of debt. And finally, there might be a gradual inflationary erosion. Financial repression are efforts that the government takes to help to keep prices from going up or to help move some of the debt. So if the government were to require people to buy treasuries in their retirement accounts, that's an example. Yield caps are where they keep the interest rates artificially low. And then there's this silent wealth transfer that happens. The wealth transfers from savers to the borrowers. And that happens silently over a long time. It's a matter of the debt getting cheaper as the inflation goes up and the value of the dollar goes down. And the people who are paying that are the people who have savings. Okay, so as you look at this, if things are relatively in balance, we're kind of in the center there at the cross. But as you go higher or lower or further to the right or further to the left, things get worse. And that's what I'm trying to communicate in this fiscal crisis map. So in the center, there's tension, but there's relative balance. So things aren't really bad. And I think that's kind of where we are right now. We have some inflation that's shown up recently. It's not been going on too long and it's not too high. So I don't have an econometric quantitative model. I'm not an economist, but I'm just using powers of observation and general awareness to say, I think we're kind of here. Now, what the most likely scenario that the CRFB says we're going to have in the future is this gradual inflation. That doesn't call for any kind of shocks or any kind of major short-term disturbances to the economic system. It's just over time, the dollar is going to lose some value and prices are going to go up and the government's going to be paying back with cheaper dollars. Now, they also say there's a possibility of acute deflation where the stock market breaks or a couple of banks fail. We looked at that back in 2023, Silicon Valley Bank and a few others, right? So that would be a short-term deflationary episode. Now, the interesting aspect that the CRFB points out is that a couple of these can happen at the same time concurrently, or more likely is one kind of crisis is not going to stay there necessarily, that it may evolve. So an acute deflationary crisis might gradually turn into an inflationary crisis, right? And in addition, the idea that this gradual inflation over time, if that's over 5 or 10 years, well, there might also be the acute inflationary episodes. Think about the oil embargo in the early 70s, right? There was inflation already, but then when that happened, that really shot up the inflation for a shorter amount of time, very high. And then it came back down. It was still inflationary, but it still kept going. At the beginning of this video, we imagined being in a room with a quiet elephant. The elephant just stood there, calm, still, almost easy to ignore. Nothing was crashing. There was no panic. But elephants don't need to charge to change a room. They could just keep growing. That's what Dalio and the Committee for a Responsible Federal Budget point to in their own different ways. Debt pressures build. Policy responds. Outcomes can land in different places. Inflation, stagnation, stagflation, market declines, even the possibility of default. The goal here does not involve prediction. It involves orientation. When you understand the map, you can avoid reacting emotionally. You become aware of some signals, so you start watching, start monitoring deliberately. The elephant is quiet for now. There's no reason to panic or even fear. This gives us a window for preparation. And preparation always feels calm until the room starts getting loud. This material is for educational purposes only. There are no recommendations to buy or sell any investments. All investments involve risk. See my full disclaimer statement on the following slides. Take care.